The crash that everyone's talking about right now will be worse than 2008, but not in the way almost everyone thinks it's going to happen. You see, the media has been bracing you for another crash, right? They're calling for a housing collapse, they're calling for a stock market wipeout, but that's not the real danger. This time, the bubble isn't in real estate. The bubble's not in banks. It's in a completely different sector that no one's watching. And when it pops, the crash effects will be nothing like what most people are preparing for. And here's why this is so dangerous. When the thing that everyone thinks is safe is actually the bubble, it means your savings, your retirement, and even the cash in your pocket, they're all on the firing line.
For years, audiences have been trained to expect a repeat of the past. The story you are about to hear flips that script and reframes what a crash looks like when the pressure point is money itself. Our guide argues that waiting in cash is not caution, but concentration risk in disguise. If the foundation erodes, assets that feel expensive can actually be escape hatches. The goal here is not to predict fear, but to map a route toward owning scarcity before scarcity owns you.
Most people are stuck fighting the last war, right? And in our case, that means most people are expecting a market crash like we had in 2008. That's the last war. Maybe they're looking at 2000 or whichever period that you want to look at. But those were different. Those were deflationary crashes, a housing market crash, a credit bubble crash, a stock market crash. But when these markets crashed, we saw stocks drop, right? By more than 50%. Home prices, they collapsed 30 to 50%. Banks failed, unemployment skyrocketed. That's what happened. And as painful as that was, on the other side of all that, we saw huge growth, right? Because the crash was sort of like a reset button. After the crash, if you still had cash, you could get back in, right? You could buy that home, you could buy the stocks much cheaper, and then you could ride the recovery back up.
That reset myth fuels a dangerous patience. The expectation that everything will go on sale again keeps people parked in the very instrument at risk. In a world where the denominator is unstable, price tags tell you less about value than trajectory. This time, the plan is not to wait for a clearance rack, but to front-run the shortage of safety. That means choosing the vehicle before the rush, not after the signs go up.
So they've been waiting on the sidelines. They've been holding their cash. Some of these people have been holding for 2 or 3 years because mainstream media, other prominent financial channels, online, some other YouTubers, they continue to tell you that this market crash is coming. Look at the debt, they say, right? Look at the inverted yield curve. Look at all the other reasons. But here's the thing. That's not what's coming. And if you're waiting for another 2008 crash, you're going to get wiped out.
Performance is the ultimate referee, and it has not been kind to the old playbook. When money flees, it seeks perceived scarcity or resilient cash flows, not theoretical safety. That is why certain indices sprint while broad baskets jog. It is also why cash-heavy portfolios feel stuck even as headlines brag about bull runs. The divergence is the clue, not the anomaly.
Since I made that call in December of 2023, Bitcoin's up 186%. Gold, which so many wrote off as dead money, has surged almost 95%. Even the NASDAQ and the S&P have moved higher, up 52% and 46%. But notice what's lagging. The broader market indexes, like the Russell 2000, right? It's barely up 30%. So if you'd been sitting in cash on the sidelines waiting for another 2008 style crash, or if you'd followed maybe Ray Dalio's all-weather portfolio, which is the classic Wall Street playbook, you'd be way behind right now.
Positioning is not about bravado. It is about probabilities and the path of capital when confidence in currency thins out. Equal weight allocations to the right set of scarce or growth assets can outrun traditional hedges precisely because the threat is inflationary. The scoreboard reflects a world where safety is redefined by scarcity and network effects, not by coupons. If the storm is in the currency, you do not buy more umbrellas made of paper.
A simple equal weight allocation in the top 4 assets, Bitcoin, gold, NASDAQ, and the S&P, would have turned a $100,000 portfolio into nearly $194,000 by October of 2025. Meanwhile, Ray Dalio, the all-weather strategy, would have grown to about $118,000. That's a difference of $76,000 in just 2 years. That's a 64% outperformance just by positioning for the reverse market crash that I called back in 2023 instead of clinging to the old playbook.
To understand why this gap exists, look beneath the asset layer. The bubble thesis points at the base of the pyramid rather than the top. If debts grow faster than trust, the safest asset becomes the riskiest hiding spot. In that world, the smartest money steps off the sinking foundation and onto harder ground. The irony is that the migration looks